gentlemen, good day and welcome to the Schneider Electric's Q2 FY2023 conference call hosted by Elara Securities Private Limited. As a reminder, all participant lines will be in listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Harshit Kapadia from Elara Securities Private Limited. Thank you. Over to you, sir.
Thank you, Chris. A very good evening to everyone. On behalf of Elara Securities, we welcome you all to the Q2 FY23 and H1 FY23 conference call of Schneider Electric Infrastructure Limited. I take this opportunity to welcome the management of Schneider Electric Infra, represented by Mr. Sanjay Sudhakaran, Managing Director, Mr. Mayank Holani, Chief Financial Officer, and Mr. Vineet Jain, Head Investor Relations. We will begin the call with a brief overview by the management, followed by a Q&A session. I'll now hand over the call to Mr. Sudhakaran for his opening remark. Over to you, sir.
Good afternoon, everybody. This is Sanjay Sudhakaran, Managing Director of your company, Schneider Electric Infrastructure Limited. I hope all of you are doing well, and we will go straight to page number 3, where we have a small glimpse about the economic outlook for India. As you can see, India has been performing pretty well during these turbulent times. I think it's one of the most attractive economies, as you can see, globally. Probably because India has managed to insulate itself from the energy crisis which many countries like in Europe are facing. And at the same time, the prudent fiscal policies have also paid off in terms of a stable economy. We feel that from the overall macroeconomic statistics that India will continue to have a good run going forward. However, these things are a little bit unpredictable given the global economic situation that we are facing. There are talks of global recession in the US. There are talks of uncertainty in Europe. We've heard about the UK issue and things like that. And we need to be cautious about the fact that the economy cannot be decoupled from the world economy in general. So I think we should look forward to the next few quarters with cautious optimism. We go over to the next slide, which is page number 4, taking off from the macroeconomic scenario into what it means for us, for our core segments that we operate in. Power and grid was looking to be a very promising story with the government-linked incentives towards modernizing the grid, etc. But there seems to be a little bit of a slowdown in the actual deployment of funds that one would expect into this segment, given the mandate that was given to more or less privatize the power and grid utilities and also to modernize the grid in that process. However, we feel that even with the time lag, there will be investments flowing into this sector in the next few quarters. So we are optimistic about the segment, though there might not be an upside that we anticipated it to have. On the mobility side, I think investments in infrastructure continue to grow, especially on the metros, that is urban transportation, tunnel projects, as well as new airport infrastructures that are coming up. On the minerals, mining and metals, I think the story has been pretty good so far. However, we can expect some amount of a slowdown in the steel sector, primarily because of the incentives to this sector that were provided in terms of higher duties on exports out of the country. There is consolidation also happening, as you would have read about, with Holcim exiting India and Adani Group taking over. However, there does seems to be sufficient capex that is flowing into the cement industry. So we expect cement to grow for some more quarters as we go forward. Industry and buildings has been kind of muted, especially due to the COVID. But we feel that investments in this area will come back strongly, and vacancy rates are falling across the country in terms of commercial buildings. People are coming back to offices, so we would expect a rebound in the buildings industry as well. Driven by the data loss, I think the cloud and service providers or the data center industry continues to flourish, with more and more multinational players coming into the country, and also we see good amount of interest among some Indian real estate developers also to capitalize on their land bank and their ability to develop real estate pretty quickly. So we see many joint ventures by real estate companies going into the cloud and service provider segment. So we expect this market to grow as well. So overall, I think for our core segments, the outlook is positive. Just to give you some glimpse of the kind of orders that we have been bagging, I think we got a pretty large order from Bhutan where we are helping the country with its electrification needs. This is a repeat order, something of the similar magnitude which we had last year. We continue to serve the customers in a very engaged manner despite all the challenges of supply chain as well as COVID. And we have managed to get a repeat order for 33 kV and 11 kV package substations. I'm sorry. A large order from a global data center customer for 33 kV GIS package. This is the second order, a repeat order from the same customer in quick succession. I think our strengths here have primarily been faster deliveries and making sure that we execute the projects flawlessly. So positive news here as well. On minerals, mining and metals, we have a large order from the steel industry, a fully connected product with integration with software. So an intelligent solution in line with our strategy to digitize more and to be able to deploy more and more EcoStruxure solutions with customers. We go to the next slide, which is industry and buildings. This is for a government establishment building, a pretty good infrastructure, and again in terms of digital and connected, where we have transformers, HT panels, ring main units, and package substations, all connected products, and we will be able to leverage cloud analytics here as well, as we are creating a roadmap for that as well. So this is a good win in the building sector that we can be proud of. Another area which is of keen concern, keen interest to us, I would say, is centralized building management, where we continue to deploy our software assets like advisory layers on clouds to be able to move buildings from being managed building by building into more of a central command center. This will help organizations and the building industry to move towards their objective of net zero, being able to manage their assets proactively with predictive maintenance, etc. So this is a huge step forward with one of the IT companies that we have done in deploying our asset advisory solutions onto other solutions as well from the Schneider basket, including building management and connected products. We'll go to slide number 10, which is on services. Here is an acquisition that Schneider made globally, which is for a transformer analytics company. It's not a transformer manufacturing company. It's a purely analytics company with sensors and softwares, which will help customers predict the life cycle of their transformer assets, be able to take proactive actions and extend the life of the product as well as make sure that the transformers perform to better uptime and efficiencies. So this is a global acquisition which we are actively working in India for pilots, etc., to be able to deploy quickly in the country. Let's go to slide number 11. I think we are at different maturity levels as far as our accelerating digital is concerned. This includes digitizing our products, being able to connect it to cloud, and being able to provide a capex to opex conversion. So we see that the power and grid sector continues to be highly regulated because it's a national infrastructure. So there are restrictions on connecting to cloud. So our deployment has been slow here, but we have many other edge control solutions which need not be connected to cloud, so which we are deploying with these customers here. On the transportation side, we are working with key metro customers to be able to provide them with more and more digitized solutions. We have spoken about certain reference projects that we have won on the steel side in minerals, mining and metals, where we are digitizing the entire powertrain. Of course, industry, buildings and cloud and service providers also remain our focus as far as digitization is concerned. So EcoStruxure Asset Advisor, which is a primary software layer, which is on the cloud, which is what provides us with the service stickiness and lifecycle revenues with our customers, which is profitable and accretive to the company, as well as helps our customers in bringing down their operational cost and better efficiency and asset productivity, is the key thing that we are trying to promote and provide in the marketplace. Going to slide 12, all these initiatives on the digital side should be able to take up our revenues in terms of maintenance and digital contracts, which we call as recurring revenues. So recurring revenues we expect to move from a 12% in 2020 to around 22% in 2025. This is key to executing our strategy on digitization. This will enable us to be associated with our customers across the life cycle of the product. It will provide us with better stickiness in terms of customer relationship, and also pull through business that will come through from the customer in terms of spares, modernization, and other greenfield projects which will follow through a satisfied customer base. Going on to slide 13, what we want to do here is that on services, we want to reinforce the core, that is being able to get more and more service contracts, modernization projects and spare parts, with special emphasis on maintenance contracts. We also want to accelerate the growth on digital and consulting services, track our install base more carefully, and also grow our business through partners to be able to cater to a larger geography within India. So I think these are the 6 strategic pillars that we are trying to work on the services side. This is the fundamental for our pursuing digitization and cloud services to customers. Your company has been pretty much active in the mindshare with key customers. We have held a number of events with key accounts, with the Ministry of Civil Aviation, many power and grid customers such as Ministry of Power, Ministry of Energy Department in Karnataka, a strong event in Kathmandu, event in Dhaka, and also a number of events with the airport infrastructure that is coming up with GMR, etc. We have been kind of very active in our thought leadership, trying to build a good positioning for ourselves with our innovative solutions and what we can do to decarbonize and digitize the powertrain as we go forward. So with this, I hand over to Mayank Holani, your CFO, to take us through the financial update.
Thanks, Sanjay, and good afternoon, ladies and gentlemen. Operator, please move on to slide 16. Okay. So on orders for the quarter, we had a slight drop in orders, about 3% lower than the same quarter previous year, owing to the shift in some of the orders, major orders finalization to the next quarter. But if you look at the half year or 6 months period, we have a good growth of 11.6% in the outside group orders for this financial year. And next slide, please. Moving on to sales, continuing with the momentum we had seen in the previous quarter, this quarter also we have about 39.5% growth in sales. We're at about 420 crores versus 301 crores in same quarter previous year. And with this, the sales for half year stands at 792 crores, which is about 34% growth versus same quarter previous year. And we see a good momentum in almost all the segments in that sense. Next slide, please. Now, moving on to the P&L for the quarter, as we still see continued fluctuation in the raw material prices, some of the commodities keep going up and down. So at the overall quarter level, if you see, our gross margin was 31.1% versus 32.54% in previous year. And the mix also plays a role here. And the profit after tax, if you will see, is about 87 million versus a loss of 87 million in previous year, which is a delta of about 500 basis points. And there is an exceptional item, which is a gain of about 33 million INR, which is due to the sale of, we had some assets, non-operational leased land in Nemi. It was the plant closed long back. That has been disposed of, and this exceptional gain is coming due to that. Next slide, please. For half year, our gross margin has improved to 32.4% versus 32.1% in previous year, and profit before exceptional items is 193 million versus loss of 248 million in previous year first half. And if you look with the exceptional items, it's the profit after tax stands at 352 million versus the loss of 248 million in previous year. That's it from the P&L side, and on finance side. I will close here and open it for question and answers. Thank you.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. You will hear a confirmation tone that you have joined the queue. If you wish to remove yourself from the question queue, you may press star and then 2. Participants are requested to unmute handsets while asking a question. Ladies and gentlemen, we will wait a moment while the question queue assembles. Our first question is from Rajesh Kothari of Accurate Advisors. Please go ahead.
Thank you, sir, for providing the opportunity and a really good set of numbers. Is it possible for you to give a little bit more insights into which are the segments where we see strong traction from here on, and how do you see the order win over next 6 to 12 months?
So on the segment side, as I mentioned, I think mobility, data centers, and a mix of, I think, certain portions of the power and grid and cement should be strong as we go forward.
Mm-hmm. Okay. And in terms of the, if you look at the next 12 to 18 months kind of an opportunity, how do you see that, from the order book perspective?
So as we went through the presentation, I have been articulating that the markets seem to be doing well, and despite the turbulence in the global economy, I think India should be able to tide over it. And given the fact that we also are well positioned with a solid product offering, with adequate digitization content, etc., I think we we have every reason to feel positive about the outlook.
So recently, I think 1 month back, there was an announcement of a 80 crores kind of a capex for increasing capacity, and I think there is a more of a the parent company probably trying to shift from the Germany to India manufacturing plant. Can you a little bit further elaborate on that, and do you see more such opportunities?
Yeah, so I think there is a factory which is based out of Calcutta, which is primarily making vacuum interrupters, and this is a factory that caters to, as a core component factory, which caters to India as well as for many countries across the globe. So I think the rationale behind the investment is primarily to increase our exports out of India and to cater to more and more geographies, as well as to cater to the growing demand in India as well. So it's a futuristic investment that we're doing, given the strong demand that we are seeing across many global markets, and this is an additional infrastructure that we have announced.
So how this will be funded, sir?
Funding will be through partly borrowings and partly through internal accruals.
I see. So this will be spread over.
And also this fund, this 138 crores capex is not going to happen in one go, maybe in next quarter or next 2 quarters. It is expanded. If you had read the announcement about 3 years, so that will be fully functional by 2026. End of financial year 2027. So it will be a phased investment.
You mean December 2026 the capex will get over?
Yeah, March 27 financial year. That will.
But the factory will start, is like phase-wise factory will open, or the full entire capex will come on stream only from Jan 2027?
No, it will be, the capex will start probably from next financial year. Yeah. And partly some operations may start in say 24, 25 type of but it will take time moving because the operating the factory there will be some movement from existing setup also. So the fully functional will be by 27 FY27.
I see. And sir, do you see any more such opportunities? Because there are many companies, particularly in Europe, they are basically making more investments or more sourcing from their Indian subsidiaries, because energy cost definitely is becoming a little bit pain point for the global companies. Are you seeing such opportunities apart from the Calcutta, what we are looking over next 6 to 12 months?
The company is in a constant evaluation phase on their supply chain. So as and when they find something viable in terms of investments, I'm sure they will consider that.
I see. But I mean, like from global perspective, can you share in terms of the competence of the our company when they look at the the other subsidiaries across the globe? Which are the areas where we believe that Indian companies are one of the most competitive when it comes to the reliability of supply as well as the cost competitiveness?
I think across the areas, I think there are a lot of engineering services that are being outsourced to India. There is manufacturing base which can be created in India, which you can see Calcutta as a very, the investment in Calcutta as a very significant investment in that direction. There can be investments on certain other products as well. So we will intimate you as and when those efforts fructify.
Perfect. Great, sir. Thank you. I'll come back in queue. Wish you all the best.
Thank you.
Thank you.
Thank you very much. The next question is from Shriram Agarwal of Temasek. Please go ahead.
Yeah, hi. Thank you, sir, for taking my question. My question is slightly related. Just wanted to understand if you can comment on the current utilizations and how are you thinking of capacity expansion going forward, if any? And maybe if you can throw some light on both specific to the company and investor in general.
You mean capacity utilization, the plant capacity utilization, right?
Yeah.
So see, we are, I can say about 85% you can say on the overall basis in terms of capacity utilization. But obviously there are fluctuations, and if you have more load, the capacity is you add the shifts, and there are also the capacity is distributed across different product lines. So that keeps fluctuating because sometime in some quarter or some year you have more load in one product line and then other. So that keeps moving around. So and when the load is more, as you see typically in December quarter we have a higher volume. So then probably we used to do extra shifts.
Okay, and
something called as a 5-year planning exercise. So what we do is we look at the projected CAGRs of the market, our new product introductions that are planned, existing business as usual, what is the CAGR that can come through that, and all this we plot to try and find out as to at what point in time we need to trigger a capacity expansion and what form the capacity expansion could take. It can be in terms of certain amount of outsourcing to certain amount of insourcing, plant and machinery, people, etc. So this is a very robust process which is followed by the company every year, where we plan 5 years in for N plus 5 years.
Understood. And if I may just an extension of that question slightly, given the demand which has revived quite a bit, and that given the fact that we are already at 80-85% capacity utilization, do you see in near to mid-term any major expansion plans, or do you think as you mentioned earlier that in December quarter you just end up extending shifts to make up for the increased demand? So measures like that would help in the near term.
Analysis does not show any immediate trigger to do something very radically different. We have a roadmap to be able to cater to the demand through adjusting various other parameters.
Got it. Thank you. That was my question.
Thank you. The next question is from Raj Rishi of DCPL. Please go ahead.
Hi. Would like to know the digital offerings of Schneider, your parent. Is it all in this listed entity?
So, as you know, we have a execution arm, which is in terms of projects and in terms of services. Now, all digital offerings are accessible by the execution arm as well as the services arm of the company. So we have the ability in terms of products and the capability in terms of integration to be able to deploy these products and services, primarily focused on digitization of the powertrain.
I didn't get you. Primarily focused on?
Digitization of the powertrain.
Okay.
You see, digitization can be process, digitization can be building automation. So we stick to our core, which is digitization of the powertrain.
Okay. And any conflict of interest between, say, the listed entity and other subsidiaries of the parent in India, or it's clear-cut defined what each will do?
I think it's pretty much clearly defined.
Okay. And how do you see data center as a business opportunity for you? People are talking about massive growth potential over a period of time, because it seems to be energy intensive and labor, both of which should be good as far as India is concerned.
Yeah, I think it's a good opportunity for the business as far as medium voltage and solutions are concerned. And I think I spoke about it at length, both in terms of the segment dynamics as well as the digitization opportunity there.
Okay. And sir, any time frame to retire the borrowings which you have from the other subsidiaries of the parent? Do you have any strategy in place or something?
See, we are it's as you see, we have started into getting into a profitable zone from last financial year, and rather this quarter is the fourth consecutive quarter, right? Where otherwise we used to have in between you will see the some quarters with profit, then again losses. So once we are back on profitable and growth in terms of on a consistent basis, then obviously that will help reduce the borrowings when we generate the cash from operations.
Okay. But sir, you also said that the capex which would be done would be from internal accruals plus borrowings. So,
yes.
The internal accruals will go for the capex, then how will you retire the borrowings?
Yeah. So see, there are different things we are working on, and the capex is also, as I mentioned, not going to happen on day one, right? It will be spread over the next 3 to 4 years.
Thank you very much. Ladies and gentlemen, may we ask please that you restrict your questions to 2 at a time and then rejoin the queue. We'll move on to Viraj Mithani of Jupiter Financial. Please go ahead.
Yeah, good afternoon, sir, and congratulations on good set of numbers. Am I audible?
Yes, you are.
Yes, good afternoon. Thank you.
Yes, sir. First, 2 accounting questions. One is that our employee cost has been constantly high, between 15% on quarter to quarter, 18.5 half yearly, coupled with 70% of material costs. I don't understand why our employee costs are so high. Are we expanding, or is we are the only company having such a high employee cost?
See, Viraj, the employee cost for the quarter, if you see, is high because this quarter there is this cost of employee share options plan which gets booked in this quarter. So on an absolute number basis, you will always see in the September quarter an employee cost going up from the previous quarter. But annual, if you see year on year, the increases due to the normal inflation, while we continue to work on optimizing and restructuring based on the business evolution.
So what would be the ideal employee cost we'll be working in future with, like just for just to get some fair idea into that?
Viraj, actually, our business is on the cyclic, and the H1 is usually lower than the H2. So if you are looking at the percentage in H1, it's looking a bit high. But as a year-end level, if you see, it's not 15 or 17%. It's around in between 12 to 13%. So looking at the current opportunity that we are seeing in the market, so as of now, we are not seeing any much decrease in terms of the employee cost numbers. But yes, definitely it will help us to increase the sales volume. I hope that way I am able to answer your question.
Thank you, sir. The next question is from Nikhil Jain of Galaxy International. Please go ahead.
Yeah, thank you for the opportunity. I just had one question. So I just wanted to get a view on what is the kind of EBITDA margin that this business can actually deliver. Right? So it has been quite variable, and we have been improving. But what may be let's say, a sustainable EBITDA margin that the business can actually deliver over a reasonably long term? So can we say 10 to 12, 8 to 10, something like that? If you can give a view, what do you think about that?
See, if you look at the numbers for last few quarters, this P&L has been impacted a lot by the fluctuations which we have seen in the commodities, right? So which has make it a bit unpredictable and sometimes going up and down. So while our focus is to continuously improve, and that's where we do a lot of selectivity in terms of what kind of orders we pick up, and the focus is always on picking up orders with better margin than with the focusing just on the top line. So our focus is to consistently improve EBITDA margin on a year-on-year basis. Quarterly numbers may vary based on some mix of different products and projects, because that's that's something which you can't manage on a quarterly basis exactly to the number. But our focus is to improve it on a ongoing basis. But yes, last few quarters, if you see rather last 2 financial years, obviously these are impacted by the supply chain challenges, whether it's electronics or raw material prices and even the freight. So that has impacted EBITDA margin, and that's why on a quarterly basis you will see very big fluctuations. But though I would not quote any number, but we are working on consistently improving, and that's where if you see the numbers for last 2 financial years also, it has we have improved in last financial year also by about 0.7% in spite of the raw material and supply chain issues. But
So can we say, so in a normal world, right, which is difficult to predict, but in a normalized world, we can, let's say, look forward to at some point of time an EBITDA margin of 10 to 12% kind of a range, which is, or we will be working towards that.
From today, where we are, 10 to 12 is quite a distance. So yeah, we will continue, pushing for a better margin and focusing on it. But yes, it will take time. It's not going to happen, say, in 1 year or a few quarters, right? 1 year, 2 years.
Thank you very much, sir. The next question is from Sanjeev Zarbadi of Schneider Investment. Please go ahead.
Yeah, sir. Thanks for taking my question. Sir, my question was again on the debt side, because if we look at our debt compared to other capital goods companies, we are much on the higher side. And if we want to grow, then our working capital will also increase. And we also have a capex plan going ahead. So would like to know what kind of vision we have, where we want to see this debt 3-4 years down the line. And the second thing is, another way to reduce the debt is if we can increase our margins. So on that, already to some extent you have answered, but would like to know to what extent the material prices have to go down or something, or where we want our execution to reach so that our margins reach somewhere around 10 to 12%, still lower than the parent's margin, which is around 15%. So some thoughts on that.
You rightly mentioned that our margins are on the lower side in comparison to the parent side. So yes, we are working towards to minimize the gap as much that we can do given the Indian market. And in terms of the debt, we are saying currently the management has a view to reduce the debt from our operationals, and if we find any other further opportunity to optimize and reduce the debt, definitely we will work on this, and at appropriate time we will communicate to the market.
And sir, regarding the order intake, is it possible for you to quantify the roughly the amount of orders that would have spilled over to the current quarter?
Close to the 450 to 500 million would have spilled over to this quarter.
Thank you. The next question is from Sanjay Sapati of Ampersand Capital. Please go ahead.
Yeah, hi sir. So in this quarter, your raw material cost went up compared to the June quarter, and that despite the fact that key raw materials like copper and most other things, they went down. So how do you really explain this, sir?
See, even in the last Concall also, we have specifically mentioned that the raw material cost for the last quarter was abnormally low, just because of a few of the orders are mixed. And secondly, the impact of the raw material up and down will not immediately impact on the quarter, because we are in a business where at least you need 3 to 6 month period to actually execute order and to convert it into sale. So in this quarter, that when we have purchased the material was on a higher side, and of course that this impact is coming. So definitely in the future quarters, you will see the impact of downgrade side of this raw material or all the metals that's going down. But because the cyclic business, this impact is coming. And secondly, it's also mixed with some of the forex side, because some of the imported material in the forex is going the opposite side, which has further impact on the raw material side.
So on the forex side, which I would assume that you import mostly from Europe, right, sir?
Not mostly, but yes, majority is
a significant part is from Europe, but we have imports from China as well. China, UK, other parts as well.
Thank you. The next question is from Manish Goyal, who is an individual investor. Please go ahead.
Yes, thank you so much and very good afternoon, sir. Sir, like we have been talking about adopting digital offerings and in today's presentation we have spoken about our Vision 2025 on the services. So would it be just possible to give us perspective like how has been journey like in terms of how the revenue contribution has increased probably in recent past and how do we see it going forward? Because we have given a breakup about maintenance and digital contracts revenue increasing from 12 to 22%, but I believe that is part of the overall services. So maybe if you can give us a perspective, how do we see this revenue share increasing going forward, and what does it imply for our margins as well, sir? That's the first question.
So I think the information that is there on the actual data and the vision that we have shared with you. I'm not able to understand.
No, like in overall revenues, what could be our revenue from both digital offerings and the services what we are aiming to grow that? Like as a layman for a shareholder, how should we kind of benchmark this or visualize this?
So the idea is to grow services share in the overall business to a better contribution, and within that to grow digital and recurring to a higher contribution within the services mix. So both these mixes, because of the higher operating margins, should be accretive to the gross margin story.
Sure. But any aspirational numbers by 2025, what should we kind of expect services revenue to be like?
So we don't want to give a forward-looking guidance in that with so much of granularity. So please excuse us for that.
Okay. And on employee cost, ESOP, last quarter I believe we had a 8.1 crore as a ESOP cost. So what would it be in the current quarter?
It's in the same range, Manish.
Around 8 crores. And how do we see the supply chain challenges on, say, like availability of the semiconductor chips, and has it eased out, and do you see that it probably not hamper our revenue growth going forward, and we probably have our peak December quarter coming up, so just want to get a perspective.
So we have been managing this crisis all throughout now for almost 6 to 7 quarters. I think with the support of our global parent, we have been kind of being able to manage our global relationships with suppliers to be able to manage that. The challenges are real. We have been supported by our customers as well in this journey. So I would like to thank all our stakeholders, whether it is our customers, whether it's our suppliers, our parent company, and everyone for supporting and making sure that we are able to kind of continue to deliver on the top line that we have been projecting.
Thank you, sir. The next question is from Jatinder Agarwal, who is also an individual investor. Please go ahead. Jatinder, your line is open. Would you like to ask your question? Very well. We're moving on to the next question, which is from Aditya Diora of... Sorry, Jatinder, can you hear us?
Yes, I am on the call.
Would you like to ask a question, sir? You were in the question queue.
I'm sorry, my network is a bit patchy. I have just one question, and this is related to Schneider Electric India Private Limited. Can you please explain me, in layman terms, what is the big difference in terms of the business of the listed entity and this one?
I didn't get your question. Can you repeat your question?
Yeah. So there is another listed company which is Schneider Electric India Private Limited, right?
No.
Of the group. Sorry?
Schneider Electric India Private Limited is not listed.
No, it is an unlisted company of the group, right?
Yeah.
Yes. And so the only question is, I would like to know what is the differentiation in terms of business of the listed entity versus the unlisted, and if you could just explain that more in layman terms as an outsider to better understand the differentiations and the overlaps if there are any.
So Schneider Electric, the unlisted entity holds a number of other businesses which are like the UPS business or the automation business, home and distribution business, low voltage business, etc. So there are a number of entities in India which belongs to Schneider Electric, not just SEIPL. So there are a number of entities in India that cater to different segments of the market. This particular entity is focused on the medium voltage electrification needs of customers. That is the charter of this company.
And there are no overlaps between the listed entity and the business?
There would be a very small overlap between the company, between some of the portions that have been acquired under from L&T, etc.
Okay.
There will be a very small overlap in that segment, but that's a separate brand that is not operated under the Schneider Electric brand.
Okay. And is that so when we look at some financials, obviously I have taken this from third-party sources, but when I look at last 10 years, revenues in that business have almost become like 3x. And the listed entity obviously has barely managed about 1.5x in 10-11 years. Over this 10-11 years, are there segments that have got interchanged or whatever in the entities?
No, the segments interchange does not affect the business because the medium voltage technology business rests entirely with this company, so it does not rest. But these things are not comparable because Schneider has had both organic as well as inorganic growth, and it has a number of product lines that are operating in India.
Thank you very much. Ladies and gentlemen, just a reminder, if you could please restrict your questions to 2 at a time, and we can rejoin the queue. Our next question is a follow-up from Rajesh Kupari of our Backward Advisors. Please go ahead.
Yeah, hi. Thanks for providing the opportunity again. My question is, the direction of the margin. You said that, your efforts would be to improve the margins. If you have, let's assume, say, 3-year kind of a roadmap, that how do you plan to improve this margin? One, you talked about the services business is going to increase from currently where are we. What are the other various steps we are going to take to improve the margins? Because your capacity utilization is already 80 to 85%. So at 80 to 85%, if you are operating at, 6% kind of a margin, then basically I'm just trying to understand where is the leverage will come from.
So there are a number of actions that one plans for this particular activity. One is to probably localize more and more in the country, reduce reliance on imports, enter new segments of the market with newer product introductions, business selectivity, digitization, services growth, recurring growth, transactionalization of the business. So there are a number of such levers that are being applied along with the transformation that customers are going through. We must remember that the market is also changing. The market is also asking for more and more solutions which requires decarbonization and electrification and digitization. So I think the needs of the customers are changing, and with the technologies that we have, we should be favorably placed in the marketplace. So some of the factors that will contribute to the margin expansion.
Okay. So, for example, the first driver you said is say localization. So currently, how much we import versus localization?
So it's not just a matter of how much we import versus the market also will change, right? The market will be going for more and more high-end products. So when you localize those products in India and you transfer those technologies into India, the ability to get more margins. So the mix change also happens along with localization.
Yeah, I'm just trying to see. I think everybody's just focusing on this call because everybody is after the fourth quarter, and that's a really great job company management has done. So everybody's just trying to understand that from here to your roadmap, and I'm sure you will able to meet your target. What are the various things, and a little bit, if you can share a few details on that. That currently, where are we, and what are the exact directionally what we are planning to do with some probably hard facts. Then that gives probably more as an external minority shareholder, we get a little bit more color into that.
So I'm not sure if I can provide you with more granularity than the overall strategic direction that we are applying going forward. Otherwise, it will look very specific in terms of forward guidance.
Thank you very much, sir. The next question is from Biraj Mutani of Jupiter Financial. Please go ahead.
Yes, sir. I would like. Am I audible, sir?
Yeah.
Yes, sir. I would like to have your some color on this EcoStruxure platform in terms of EBITDA and PAT margins and growth, and your digital consultancy which you talk about in your slide. So
yeah.
If you can give some color.
So digital consultancy is all about certain acquisitions that have been made globally in terms of our ability to digitize the powertrain and provide customers with insights as to how to optimize the powertrain. So we are building that competency within the company to be able to use those, leverage those acquisitions into value propositions for customers. So the idea is to have an agnostic consulting with customers to be able to help them optimize, and that increases the stickiness of the customers with us. So that is the idea of consulting. And what's the second piece of question? I just missed.
So in the consulting, does it mean the margins will be on the higher side? Referring to the same question, it means we'll be having the much higher margins compared to our products and all right now.
So consulting per se, if you see as a product line, might have higher margins, but it is not just the benefit of that which accrues. It is also a benefit of increased customer loyalty, which would come, and then being a trusted advisor and having the first right of refusal to a project. So these are some of the benefits that come in terms of both top line and margin expansion on the existing products as well.
So my next question on EcoStruxure, can you throw some more light in terms of growth prospects there, margins which we can enjoy? I understand we have a sharing arrangement with the parent,
So EcoStruxure margins are per se not measured as a product or a product line. This is a bundled solution that you provide to the customer. And when you bundle the products, it is your ability to price up based on the value proposition that you have with the customer. So it is not measured directly in terms of what is the margin on this product line and what is the cost that is associated with it and what is the drop through that you get out of it. It's not measured that way. It's measured in terms of your ability to sell a project to a customer at a particular price and margin. Am I
Thank you.
making sense?
Thank you, sir.
Hello.
Thank you, sir. The next question is from Manish Goyal, who is an individual investor.
Thank you again for the opportunity. If I can get what is the outstanding order book and the breakup of the same, and also similarly for order inflow and the revenue share, please, for the quarter two.
Okay, so in terms of backlog, it's around 1,000 crores, and ratio is around 63% is system, 21 is transactional, and the 16% around is services.
And on the order inflow, if you can, you can also give me the IG, what was the order inflow and the breakup of the external inflows, please?
IG will be around 90 crores this quarter, and the breakup is equipment 48%, project 12%, transactional 22%, and the services around 18%.
And for the revenue breakup, please?
It's again, equipment is 43%, project 10%, transactional 20%, and services around 8%. And IG will be around 19%.
Sorry. Can you please repeat again?
Equipment is 43%, project is 10%, transactional is 20%, services is 18%, and balance is IG.
Okay. Thank you so much.
Thank you. The next question is from Akshay Kothari of Envision Capital. Please go ahead. Ms. Kothari, your line is open. Would you like to ask your question? We'll move on to the next question from Sanjeev Sabadi of Schneider Investment. Please go ahead.
Thanks, sir, for taking my question for the second time. So I just wanted to know, were there any, revenue mix changes in this quarter because of which the margins declined on a quarter-on-quarter basis?
Yes, there is a mix change impact, obviously, because last quarter margin, June quarter margin was abnormally high. If you see it from any of the previous quarters also.
Yes. Okay. So this time maybe the services component would have declined and more of project would have increased. Is that?
Yes.
Okay, great. Thanks.
Thank you. The next question is from Dhavan Shah of Alpha Advisors. Please go ahead.
Yeah, sir. I have just one question, and that is related to that order flow, which is, this spillover. So can you share that number again? Was it 45-50 crore?
Yeah, it's in the range of it's an opportunity, not the exact order number. It's an opportunity.
It's opportunity which were not closed in previous quarter.
Yeah, that was 45-50 crore. No, number is correct, right?
Yes.
Okay. That's all from my side. Thank you.
Thank you. Ladies and gentlemen, I will now hand the conference over to Mr. Ashok Kapadia for some closing comments.
Yeah, hi. Thanks, Chris. We would like to thank the management of Schneider Electric Infrastructure, Mr. Sanjay Thakare, Mr. Mayank Kolani, and Vinay Jain, for giving us an opportunity to host this call. We would also like to thank all investors and analysts for joining for this call. Any closing remarks, Sanjay, sir, that you want to share?
I'd like to thank everyone for taking the time out and participating along with us in this discussion that we just had. Thank you, everybody, and have a good day, please.
Thank you very much, sir. Ladies and gentlemen, on behalf of FY Securities Private Limited, that concludes today's call. Thank you for joining us, and you may now disconnect your line.